I think one thing that, obviously impacts the profitability significantly is depreciation and amortization. So that's like, hundreds of millions of dollars per quarter for Tesla. And in my opinion, at least, the how Tesla accounts for that is probably pretty aggressive. I think I'd have to go back and look at the 10Q or the 10K, whichever one's it's in, but they kind of outline their depreciation strategy. And like for the equipment for the Model 3, for example, most of that's amortized over, a million cars produced, which I think Tesla can probably, this is speculation, of course, but I think there's a lot of equipment that Tesla has on the Model 3 that's going to, produce more than a million vehicles, because once it's fully up to speed, that's going to be maybe 3 years of production if we're talking from Fremont, possibly even less. So I think a lot of that equipment can extend beyond sort of how Tesla accounts for it. And then aside from that units of production method of depreciation, they also use straight line depreciation. So they're accounting for things for a certain amount of time, which as production gets ramped up, you obviously have more depreciation hitting in those periods of time where you have lower production. And then because it's constant per time, as you ramp up production at any given period of time, the depreciation per unit comes way down. And that's one of the things that allows Tesla to show improving profitability as they get production up. So as Tesla continues to get production to full scale, both in Fremont, and then eventually we'll see this in Gigafactory Shanghai and things like that too, that depreciation hits their profitability significantly, but that's just an accounting thing. That's not a cash thing. And that is one of the reasons that Tesla can have free cash flow positive without showing profitability. And I think that's why we're really focused on the free cash flows, because that's how Tesla funds the business. It's not through accounting profitability. Yes, of course, over time, like those things need to coincide, but theoretically, as Tesla continues to grow production and capture better profitability, those profitability will improve and then eventually become positive as well.
Yeah. And that's a great point. And it's like, we're not in an accounting class where it's like you're looking at one metric and it only lives on the spreadsheet. It's like we're thinking about this as a business that needs to grow, that is constantly changing and evolving. And I think, to translate a little bit of what you just said into English, they buy their huge robots up front. That costs a ton of money, but they're not counting for that expense up front. They pay for it up front, but on the income statement, they do it over time as they amortize and depreciate those assets. But the point is, from our perspective, the cash has been spent. All the robots are in Fremont. Now they're just building more cars. That's why Tesla pumped out 500 million last quarter. So that's why at a high level, they're not profitable on the income statement in Q3, but why am I pumped? Why is the thesis working? Because I was like, okay, they're going to spend a couple billion, build out all this equipment for Model 3. After that's spent, if this thesis works, if they can build cars profitably, which nobody thought they could, then now they should be pumping out hundreds of millions and be really in a solid financial position, validating this sort of pattern of like, we're going to spend a couple billion up front and we're going to get a ton back. And so I think if you look under the hood, this business is, the Bloomberg article about look how much money Tesla burns each second. That flipped. They're now pumping out 500 million in cash. Bloomberg's not rewriting that article. But so I think it's funny how everyone is forgetting to look at free cash flow now, that it's amazing. But that's why at a really high level, what I see is going on, it's like, okay, they don't look profitable, but really what's going on is Model 3 worked and Model 3 is making them a lot of money. And that's why they're able to invest in Giga 3 Shanghai and building out this Model Y line now.
Yeah, and the really exciting thing about that is that Elon has said time and time again that they continue to learn from what they've done with Model 3 and Fremont. And like for Model Y, they should be able to spend even less CapEx to get equivalent production for Model Y or even better. I think he's, I'm going off the top of my head here, but I think he said like on the order of like half of CapEx for what they did with Model 3 for Model Y. So when you think about kind of like how that projects to profitability in the future, that depreciation and amortization per unit is going to be, projected at half versus what it's going to be. So like we'll see the expenses now in CapEx, but over time we should get a better return on that spend, which then should improve profitability in the future for, basically from this line item. So it's really exciting to think about that. And then on the free cash flow too, Tesla's, that's flipped very significantly. And I think over the last like 18 months, trailing 18 months, Tesla's been free cash flow positive. I'd have to double check on that. But, and then again, this quarter, I think we're both expecting another positive quarter. Kind of depends what they spend in CapEx, but they're definitely starting to show the sustainability on the cash line, which is really exciting.